sort of akin to giving you a scalpel and saying, hey, I'm democratizing surgery. But it's the economic exposure one that doesn't appear on balance sheets or income statements, or standardized reporting doesn't appear in your accounting system or ERP, that tends to cause a lot of problems and a lot of trip-ups. And we saw that recently with the dollar weakening.
Welcome to Trade Treasury Payments, the podcast unlocking the future of cross-border finance.
From transaction banking and money movements
to liquidity, treasury, and cash management.
We bring you expert insights and the latest trends shaping global finance.
Welcome to Trade Treasury Payments Studios. I'm Eleanor Hill, Treasury Editor at TTP, and I'm delighted to be joined today by Nay Thacker, who is co-founder at Hedge Flows. Nay, welcome. How are you doing?
Thank you very much, Eleanor. I'm very well, and thank you for the invitation.
It's a pleasure to see you and to catch up and to have the opportunity to talk all about FX, which is one of our favourite subjects between the two of us.
Indeed.
And I know there's an awful lot going on in the market right now. It's certainly not quiet, but you work a lot with mid-market companies and SMEs, which we'll talk about a bit more. But looking at those mid-market companies in particular, they're operating often across multiple currencies, multiple geographies. What would you say is actually the biggest risk right now? Is it the market itself, or is it those internal blind spots that prevent them from having full visibility across their exposures?
That's a good question. So I think undoubtedly it's the blind spots. And I guess the reason is like markets move and finance teams are aware that markets move. So they sort of come under the category of known unknowns, right?
Yeah.
Whereas the internal blind spots for them are sort of unknown unknowns, and those are the ones that tend to trip them up because they sort of less visible for them for a few reasons actually. And the reasons are really that if you look at the types of exposure, FX exposure in particular, and we segment them into sort of transactional, translational, and economic, right? The first two are quite well understood by most finance teams. Transactional, payables, receivables on balance sheet, and bank and sort of cash balances. Translational, consolidation of subs into the group. But it's the economic exposure one that doesn't appear on balance sheets or income statements, or standardized reporting doesn't appear in your accounting system or ERP, that tends to cause a lot of problems and a lot of trip-ups. And we saw that recently with the dollar weakening in two recent examples within our client base, actually. One, actually, it's interesting because they're both quite similar companies. So they're both, larger SMEs, so 100 million plus turnover. Both have dollar revenues, significant, and both have significant sterling costs. One of them was a creative services professional company. And again, they saw month after month after month, and they saw very little on their obviously FX gains and losses within their accounting system. But as it started filtering through, they saw month after month after month of material margin compression, and that meant effectively that they had to go in front of the board and explain exactly why their reporting framework that they've been putting in front of the board, for a long time, hadn't captured these very material factors and impacts on their on the business, and that was not a fun conversation for anyone at all. The second example is actually an e-commerce company. Again, dollar revenue, sterling costs, but they actually had a slightly different approach. So what they did was they had the ability to absorb some of the moves. So they actually report in dollars. So this appeared on their cost line.
Okay.
They had the ability to absorb some of those costs into their margin because they're a high growth company and they're fine to take a bit of margin volatility, but not all of it.
Yeah.
So then it started eating into their the most flexible costs that most high growth companies have, which is their sales and marketing and ad spend. And that started then having a revenue multiplier effect on their revenues. So generally 3x, 5x kind of revenues from marketing spend. So having cut their marketing spend a little bit, they started seeing that move into their revenues, and then it started this sort of vicious cycle. And again, that's something that most companies don't necessarily think about when they think about FX gains and losses or the impact of FX.
Yeah, that's so much
two
hidden.
examples there that were quite interesting, quite different, and quite similar. And I guess the message for, like, if you're a financial services provider or a bank looking at this, right? If I look at the RMs that covered these companies, what would they have seen, right? They would have seen a fairly clean balance sheet. They'd have seen an income statement with, assuming they had access to this, with small gains and losses, nothing too dramatic, nothing really needed here. Let's move on, right? But the reality is that the risk and the exposure was invisible to both the company and the bank.
So on that then, Nate, digging into that a little bit more, like you say, we've got these invisible exposures. They're often quite scattered and there's lots going on that people need to try and keep on top of. But where do you see the biggest gap between the perceived control around FX and the actual level of control around it?
I think the biggest gap is I think twofold. First is the economic exposure that we sort of discussed, right? So this is this is where it goes from being a sort of financial treasury discussion to actually a proper business and board discussion. If my costs go up by 10%, what am I going to do?
Yeah.
Right? What's going to take the slack? And it's actually very rare to find a mid-market company that has that conversation well in advance of something happening. And the second one is actually probably even a more fundamental gap, which is what is the objective that you're solving for here, right? Is it protecting margins? Is it protecting revenue? What are your tolerances? So just and also that has to be couched in terms that the rest of the organization, the rest of the company can understand and can agree to, right? So they're probably the two biggest gaps between sort of perceived and actual controls within the segment. Okay.
And then in terms of, I guess, if we just sort of strip it all back and look at the core of the mid-market SME issue, does it come down to access to tools? Is it knowledge? Is it just time and attention? Because particularly with the high growth companies, they're so busy doing so many other things that it's just left. What would you say in terms of where the gap is and where those interact?
I think it's actually all of them. So it's there is an issue around knowledge, right? They need to understand that Treasury is a discipline. That leads in a particular direction. There's also the sort of the access to tools piece.
Yeah.
So in order to actually do something, actually commit to a forward contract, right? You need to know a few things, right? You need to have enough confidence in your forecasted your forecast in particular, and you also need to have enough confidence to do that with incomplete information because it'll never be perfect. And you also need to be able to commit, therefore, to a tenor, a notional, and a hedge ratio, right? So doing all of that is requires a degree of sort of maturity and a degree of confidence in what you're doing. So it's the third thing is the time aspect of it, right? So if it's if you introduce a workflow that is going to disrupt what it is that a CFO is doing, right? As opposed to sort of chime in with their weekly rhythm, the chance of it getting adopted are substantially less. So it needs to be able to chime with their weekly rhythm of what they do. And that's sort of what we, hedge flows we focus on, right? We say if you're doing it weekly, it's going to be 10 minutes a week.
Yeah.
If you do it monthly, it's going to be 30 minutes a month, right? And that's it. Sort of strays from that, then something is not quite right.
Yeah. And yet we still speak to so many companies that don't hedge until they've taken a really bad hit or something has to happen for them to then be sort of prompted into action. So is that a confidence issue in terms of like they don't want to get it wrong, so they're just going to wait? Is it that solutions for this particular space in the market aren't tailored enough? What do you think it is?
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
I think it's primarily a structural problem, right? So I think what happened was when people looked at when the industry looked at the the SME or the mid-market FX problem, it sort of came to the conclusion that it was an access issue, right? If only we made it cheaper or we made it more accessible or the FX platform was better. Or we removed the minimums that were required on forward contracts, right? This is all that would be required to stimulate adoption. And the reality is that it's missing a big step, right? And that big step is knowing your exposure with enough confidence. It's sort of akin to giving you a scalpel and saying, hey, I'm democratizing surgery, right? It's a trite analogy, but it means sort of without the rest of the layers, right? Without the diagnostic layer, without the governance layer, without the education, without the communication internally, it's really very, very difficult to get that going. And as you said, it often ends up being and almost none of the companies that come to us have actually been through that process of articulating exactly what they want to do and why they want to do it. And so that whole confidence and almost fear, right, can be removed if they go down a particular path.
Yeah. And now you were recently recognised by Trade Treasury Payments. You won an award for SME inclusion. But tell us a little bit about what that actually means, because we just spoke about affordability, accessibility. But are there other elements to it, and are there markers that you recognise for when an SME is genuinely becoming more resilient with its FX risk, would you say?
No, thank you for recognising us with that award. It's something we're very passionate about. So you're absolutely right. There are markers of resilience that are actually quite, some are obvious, some are less obvious. Like the most obvious one, which you alluded to just now, was have they started hedging or looking at their exposures properly before they take a hit?
Yeah.
Right. So has their treasury is it reactive or has it become anticipatory? Right. So that's always a good marker for resilience in terms of if they've started thinking about this and understand the dynamics of their own business, their competitive position, in the market, et cetera. Do they want to protect margins? Do they want to protect revenue growth? All this kind of discussion. If that's happened, then that's a really, really good marker for resilience.
Yeah.
The second marker is actually I find it very counterintuitive, but you often hear a CFO saying, "Oh, we put on some hedges in January. We've made £80,000 already. That was a good call."
Yeah.
And in some ways, I sort of sympathise with that. But it's your hedge ratios will generally, almost by definition, be less than 100%. So if you made money on your hedges, you've actually lost more money in your underlying business, right? So it's not something to celebrate per se, because you're in a worse situation because the currency's moved against you. And similarly, if you've lost money on your hedges, obviously the converse applies. So getting finance teams to think about not making or losing money on hedges, but moving to are we delivering the business outcomes that we said we would do with respect to the what's been agreed internally about what we're going to do, right? And actually not even looking at those numbers around individual sort of hedge P&L items. That's the sort of second marker of resilience.
Yeah.
And the third one is probably more subtle still, which is, has this moved away from like the CFO or the head of finance, right? So has this, the CFO should not at a more advanced stage be the only person that sort of knows and understands the exposure. It needs to be built into the weekly rhythm of what all the finance team members are doing. And for us at Hedge Flows, the most, where we get our real kick is okay, we can measure software adoption, right? We can measure how much they're using the platform, what they're using it for, et cetera. That's easy to measure. The real interesting thing is if you were to take away that platform, would the behaviors that they're now sort of carrying out still maybe slower, maybe more manual, less automated, but would those behaviors still carry on, right? And that's the sort of bar that we hold ourselves to around, whether or not we think we've served a client, particularly well or not.
Brilliant stuff. I love all the nuances there. And like you say, around the different KPIs, very important and quite interesting to watch all of the behaviours there as well. But Nate, obviously you and your co-founder Alex have done an awful lot in terms of tech and serving that SME market. But if there was one more thing that you could change around the way that SMEs are serviced around FX, or indeed the way that they look at FX, what would it be and why?
Actually, it probably wouldn't be the SMEs themselves. As I said, I think they've been generally fairly badly served between, on the one hand, this sort of consumer grade sort of fintech infrastructure, and then obviously enterprise stuff, which is broadly speaking out of their reach. It's more about how I think banks and other financial services providers would segment that particular market, right? I mean, traditional segmentation is around turnover or transaction volume, et cetera. And what that misses is the complexity of the treasury operation that a bank, that a customer would need to run. Yeah. Right. So, for example, a 20 million turnover client that has, a euro pipeline, has suppliers in dollars, is running, risk in 8 currency pairs, can be or will be substantially more complex, and therefore there's a greater role for a financial service provider to advise them than there would be for a 60 million company that has predominantly a domestic market, and the international bit is incidental. So it's really more it's more a plea to the service providers to actually think about it from the client's perspective.
Yeah.
Think about and it's very difficult to do that unless you're embedded in the Treasury workflows yourself.
Yeah.
Right. So, because you don't get access to that data, right? That forward-looking data, which tells you about their exposures in the future, not their exposures in the past. You have to be embedded in their Treasury workflows to get access to that, right? Banks generally are not. And we, and our other sort of Treasury sort of providers are.
Yeah.
And that's the big
That's the difference.
differentiator.
Yeah, absolutely. Nay, thank you so much for joining us and bringing all of your knowledge and examples. It's been a pleasure having you on.
Pleasure as always. Thank you very much, Alan.
And don't forget to follow Trade Treasury Payments
on your favorite podcast platform.
Thanks for listening.